In this special episode, I speak with Reserve Bank Governor Adrian Orr. He shares what's next for rates and his regrets.
We could have started restricting the interest rate sooner. I do regret that we are having to sit here and deal with higher than otherwise inflation, and inflation is the big evil, not higher nominal interest rates. I would feel bad about it if I didn't think that it was for the longer term benefit of the country.
It's Friday the 18th of August and you're watching Markets with Madison. The Reserve Bank has kept the official cash rate at 5.5%, what's supposed to be its peak. But there's a small risk they could keep going higher if inflation proves tougher to reduce from here. The Governor, Adrian Orr, believes that won't be the case and hopes to lower rates in 2025. But you shouldn't take that as gospel. In my interview with Orr this week, we discussed what could get in the way of rate cuts or cause them to come sooner, as well as his regrets from his term so far. And no, the bond buying program is not one of them. Hey, Governor, thanks so much for doing this one. I really appreciate it.
Wonderful to be here.
Some people may be thinking that this is a period to tough it out, to just hold on and get through these high interest rates. But is that the correct mindset? Or are we at a new base level for interest rates and we all just need to get our heads around it?
We still think, the interest rates are at a cyclical high. So, we don't expect nominal interest rates to remain the official cash rate at 5.5%. And in fact, we think a long-term neutral rate is significantly south of that. So we've deliberately got the official cash rate in a restrictive position to make people think twice before spending and investing, because we're busy trying to cool down demand in the economy.
Well, that then begs the question that if someone is toughing it out, how long are they going to have to wait? You're forecasting rate cuts by 2025, but what would you have to see in 2025 to actually do that?
Yeah, so, first of all, the good news to people who think 2025 is a long way away, we're back every 6 weeks. So we always provide a forward projection based on how we assess the economy evolving at the moment. At the moment, as we see the risks being pretty evenly balanced around near-term growth, and inflation could be higher than we're projecting. But more medium-term, over that 12, 18-month period, we see a significant slowdown in global economic activity impacting on New Zealand's export revenues, really, New Zealand's earnings. So what do we need to see before we're comfortable that interest rates can come back off? Inflation expectations continuing to decline, which they have been doing, which is great news, and actual inflation starting to come off a little bit. That'll be lagged. But also other indicators of whether growth is proving to be less robust than even we are projecting. So, lots of indicators. We every 6 weeks we bring them all together, we put them back through our frameworks and see what we need to do. At the moment, we need to do little. We need to watch, worry, and wait.
Can you sort of list out the bad news that would be good news for somebody with a high interest rate at the moment that could cause you to cut? I'm assuming China, if you see a further slowdown there, export revenue starts tanking, and maybe if we get a deeper recession. But can you just tangibly explain what those things would have to be?
So I think the very first important point around the good news amongst all of this is that inflation is declining. Inflation is at the core of the actual challenges we've got at the moment. So the interest rates, if it turns out to be we've only had to go as far as 5.5% and got on top of inflation, that's very good news. It means we don't have to go through extremely high unemployment and all the challenges of disinflation. What do we need to be seeing that, i.e. with interest rates starting to come off? I think the most positive news is an expanded labour force. We've got strong net immigration coming in. Yes, they add to demand, but the number one constraint has been finding people to do the work. And so that's improving. The other parts is inflation globally coming off. more quickly than what is expected. It's already happening in the US, although they're still talking about a little bit more to do. But internationally, inflation pressures are declining, and that takes the heat off New Zealand's inflation pressures. So, those are the types of outcomes. I wouldn't call a slowing China good news, etc. I'd be thinking more about what are the implications for global inflation and hence our level of interest rates. And that's all moving in the right direction after a couple of really tough years, through 3 to 5 tough years.
On inflation, just how much do you hate it?
It's evil. It does no good. It confuses relative prices and aggregate prices. It misdirects investment. It most impacts on those who can least afford it, people on wages or fixed incomes. There's just no upside to it. It's noise. And so, that's where we're doing it. Interestingly, those with high debt tend to do better during periods of high inflation. The real value of your debt gets eroded through inflation. So, it's distorting, and it leads to poor economic outcomes.
You and I, just like anybody else, we have to live in this economy. Have you had a moment where you've really felt inflation and you've looked at the price of something and just gone, oh my gosh, absolutely not?
Oh, completely. The interesting part right at the moment, it's in the inflation story, and this is almost globally. It's no longer in the goods, the products we buy. It's in the services. And in those services, it's a lot of the stuff that we weren't allowed to do during the COVID period. It's restaurants, it's takeaway meals, it's all the services related to hospitality, tourism, travelling. And those are discretionary choices. So, I'm always amazed by people who are continuously complaining about the cost of living, but not making those relative choices to say, hey, perhaps I might do something different, go to a different shop, cook at home, exercise those choices. The restaurants are still full and busy, so that reflects we're still employed. But we need to be much harder and discerning as consumers to get inflation down.
Have you cut your spending personally? Are you doing your bit, Governor?
I'm reached that demographic age where I don't spend a hell of a lot anyway. So if it's available from the couch, I will consume it, but not much further.
You and I both. What's your financial situation? Do you rent? Do you own a home? Have a mortgage? Have you paid it off?
Homeowner, no mortgage at present, and an avid KiwiSaver fan.
On inflation, and I don't know if this is sort of the right anecdote to use, but I'm going to use it anyway. But the way I kind of think about it is a bit like losing weight, because that last bit could prove quite hard to shift, right? It's like the first 5 kgs, the first few percent is the easy bit, right? And then that last plateau could prove really sticky. What should we expect the Reserve Bank and the committee to do if that last few percent proves really hard to shift?
So it's really going to be, I suppose, carrying on with your analogy, it's going to be about maintaining your diet longer than what you wished for. It doesn't mean you have to be more extreme in your regime. What we did yesterday was we said, hey, we're keeping the official cash rate where we said we would, no change, but it may be there for a bit longer. And that is reflecting a large part, shifting that last part of the inflation story. I hope to be surprised on the other side. Already we are seeing some good signals internationally that core sticky inflation is now giving way to lower demand and prices. So I'm confident it will happen. But we've just said, hey, we might have to maintain the regime, for a couple of extra quarters. To be determined.
TBC, would you ever consider changing the inflation target? We made it up anyway.
Yeah, that's right. We made it up after lots of compromises. The target is for society as a whole. We don't, the central bank, we receive our mandate 1 to 3%. I don't see any sensible economic reasons why we would change the target. That's kind of, like saying my ideal weight was, 100 kg, now just shifted to 105, and hey, the 2% inflation was the kind of trade-off between zero was hard to maintain, some small nominal inflation is useful for relative price flexibility, but beyond that, there is no net benefit to inflation. A big part of the story at the moment globally is, for 3 decades, central banks were made to look good with low inflation because goods and services prices were plummeting so quickly from the China effect primarily. An extra third of the world's labour force suddenly burst into action, and we saw traded goods prices falling. That has largely run its course now, and China, is suitably struggling to find their next growth impetus. But it just means that, we will have to do more of our own work around maintaining that low inflation rather than relying on some of this manna from heaven.
Speaking of the amount of work, did the Reserve Bank, in your view, overstimulate? And are we now having to pay the price of that?
Yeah, I think there is a bit of that in there without doubt. We did our significant body of work around self-reflection, self-review. It's all available to the public as a whole. It's been internationally peer-reviewed. I think we're, at the moment, probably the only central bank I'm aware of who's actually got through that process. What were the lessons there? In hindsight, we could have started restricting the interest rate sooner. Probably not a lot more than 3 to 6 months earlier than what we actually did anyway. But there is, at the margin, a good debate that, we could have started lifting rates earlier. The pace at which we lifted rates and the end point that we've got rates to at the moment are all fine, but we could have started earlier. How big a difference would have that made to total inflation? Not a lot. We still would have had at least a 6% reading rather than a 7%. But that's at the margin with hindsight. Our biggest challenge was no one could tell us when the borders would reopen and when COVID was no longer public enemy number one. So, now that we know that, we can reflect back and go a little less. It's a global story. The other parts that caught us out is not just when COVID came to an end, but we've had a series of shocks to the economy, all pushing on inflation. The invasion of Ukraine and what we saw to global food prices and commodity prices, followed by our own severe weather patterns. There's been continuous supply shocks where supply has been constrained, prices have gone up, and we've had to do more work.
Are you now more mindful of potential overkill after that reflection?
Yes. I think, I don't know if we were always mindful. So, the strategy we took into the COVID period, one of the most uncertain periods of modern economic history, was a least regrets mindset. We said, in 12 months' time, looking back, what would we least want to be regretting? And at that point, it was to have done too little or too late in terms of keeping cash flow going and confidence going in the economy. During the last 3 years, that strategy has changed to not tightening too soon, and then over time by not tightening too late. So, we've changed through time based on the circumstances. And now, we are in a comfortable position where we can afford to watch, worry and wait for a while, let the data tell the story.
All good and well to say that you had that no regrets approach then, but that doesn't necessarily eliminate us ever having regrets. I mean, I don't think it would for me. So do you have regrets?
On the monetary policy front, no. I think we came through in an incredible period of economic turmoil, and we're coming out of it now with very high levels of employment, incredibly high engagement in the economy. Household wealth is held up. The bank's balance sheets are strong. We are in a financially strong situation. And if anything, we're in the top third of the countries around, battling inflation. So, that's a wonderful outcome to be done in a period of incredible uncertainty. I do regret that we are having to sit here and deal with higher than otherwise inflation. I'm not sure what, in addition, we could have done. Perhaps, as I mentioned, tightening a bit earlier, or probably another regret, really, or continuous challenge is to be able to explain to people what we do and why, and the things that we don't control. asset prices, house prices, the exchange rate. We play the cards that are in front of us with the instrument we have.
What about the LSAP bond buying program? Those losses totaled almost 11 billion. That could have paid for the cyclone recovery, Governor.
I think it more than paid for cyclone recovery. I'm pleased you brought that up. Actually, another regret is that accountants know the price of everything, the value of nothing. The LSAP, the IMF came through recently. They've just finished a targeted piece of research on New Zealand related to our bond buying, and they've come out and unambiguously said it has improved the government's fiscal positions considerably. How do they get to that? Well, we talk about the 11 billion. That's a mark-to-market accounting term. But what actually happened with that, the economy was stimulated, people were employed, activity continued, and the government's coffers were filled. They've been having bigger than expected budget positions, better than expected. And a lot of that is because of the work we did in the background. So it's no different to shifting the interest rate up and down. We just made money go around the economy faster using a different instrument. The accountants like to look at that book value. They aren't revaluing everything else. So that work will be made public by the IMF sooner rather than later, I hope, because it tells the proper story rather than a piecemeal accounting story.
Speaking of the story, I know you don't really like talking about yourself, but whether you like it or not, you are currently the front man for economic pain that millions of people in this country are feeling. How does that sit with you?
It sits with great responsibility and great accountability. I would feel bad about it if I didn't think that it was for the longer term benefit of the country. When we ignored facing these big challenges, we ended up with a high inflation, high unemployment economy. That's what I grew up in, as a youngster. When I left university, I think we had 11% unemployment and 25% inflation. It was diabolical. It got worse for many other countries. You look at the Venezuelas, the Argentinas, the Zimbabwe's of modern today, and those are countries who have not confronted an inflation problem. So that's what we're doing. We're just saying, hey, we're actually here to make sure inflation goes away. And inflation is the big evil, not higher nominal interest rates.
On the effectiveness of monetary policy, if anything's been highlighted to me and my knowledge of monetary policy throughout this rate hiking cycle, is the rather incredible lag between monetary policy action and then the impact of it being felt. But not only that, perhaps also the sort of limited power that the Reserve Bank actually has through those actions. What's your thinking around the current effectiveness?
I agree. I think the current effectiveness is as usual. Through economic history, I don't think it's any more or less impactful than it ever has been. If anything, it could be slightly more impactful because the level of debt is higher. So smaller changes in prices have bigger dollar implications for people. But, we have always said monetary policy has long and variable lags, 1 to 2 years between what we do now and the inflation outcome. And we're only one part of an economic story. If you're trying to, drive the whole boat just by hanging on to the interest rate, then you're going to be all over the place. Other policy has to help support. We need capable people in the labour market. We need very diversified trade. We need flexibility around jobs and skills and behaviours. It's the full package that really matters. So we are very humble about what monetary policy can and can't do. And the only thing it can do is influence the level of prices over the long run.
Yeah, the ruthless part of something like the OCR is that it targets the really heavily indebted, which are sort of mostly younger people, the first home buyers with larger amounts of debt that they're yet to completely pay off. Do you worry about the future wealth of younger generations who are currently sacrificing their savings, their future investments to pay for the cost of living and the cost of borrowing today?
Yes, I do. I wouldn't quite paraphrase it how you did, though. There are no winners from inflation. There are some people who feel the burden of monetary policy more than others. And it's not necessarily just a demographic issue. Young people may have less debt to begin with, as an example. But it's without doubt it impacts on a relative sense unevenly across the economy. At the moment, the people doing it hardest would probably be the agricultural sector, global commodity prices, and the higher interest rate. Construction is going to be slowing rapidly as the housing boom, building boom, runs its course. Commercial property is doing it really tough at the moment, in large part because people aren't heading to work as much as possible in the past. But the thing that really destroys the futures of young people is high and variable inflation, because what do you do with your money? Where do I invest? Is that a good investment or not? Finally, I'd like to remind as well that it's not just people who have borrowed who are impacted. It's people who are sitting around making investment decisions. There's now a high hurdle rate to investing, so that's a big part of business. And there are people who are saving. They're now getting rewarded better for saving. And likewise, I hope that the young people have seen that the housing market is good if you want to live in a house. It's not that thrilling, as it's not your only investment option.
I've just got two more questions. One is around shock factor. Remembering that 75 basis point hike that you went for just before Christmas last year, I think myself and most others in the market just completely fell off their chairs when you came out with that one. What role does shock factor play in your decision making? Do you see it as an advantage and try to use it where you can?
I wouldn't want to do it too often, because then you're no longer shocking people.
Good point.
And also, we didn't do it deliberately just to go out there to surprise people. We came out and said, look, we know we have to get to a level of interest rates where we are confidently restricting spending, and that's further away than what we thought before. So let's hurry up and get there. And so that underpinned it. This plus 25, there's no science behind that. That's just how people have evolved. They think we marginally do it. The real important part is the levels of where the interest rates need to be. So we went from an exceptionally low level, for all of the reasons we well understood, back to something that is more normal and restrictive, and we wanted to get there as quickly as possible. To the fact that it woke people up that we are serious, that was useful.
You're quite the king of one-liners. Cool your jets was a good one. I think my favourite one, though, was after that shock hike, telling New Zealanders to have a sensible spending Christmas. What's your words, your one-liner for New Zealanders today?
Don't fret inflation, it's going away.
Thank you, Adrian. Appreciate your time.
Likewise, all the very best.
Thanks to those of you that sent through questions that you wanted me to ask the Governor for you this week. This show is all about giving you access to people like this too. So if you have someone that you want me to talk to next, just let me know. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.